Welcome to this specialized workshop designed for tax professionals. Today, we are conducting a comparative study of professional literature and the statutory position regarding input service distributor and cross-charge under GST. This session is structured to move from the statutory foundation to practical mechanics. We will analyze how ISD shifted from an optional facility to a mandatory compliance requirement as of April 2025. Our roadmap is extensive. We begin with the statutory anatomy, followed by an evolution timeline. We will then compare three key reference articles and dive deep into the ISD mechanism under Rule 39. The second segment covers a worked numerical illustration, cross-charge valuation nuances, and the complex RCM interface. We'll also digest critical case law from Columbia Asia to JSW Steel. Finally, we will address unsettled gray areas post-2025 and provide a practical compliance checklist for your practice. This is a comprehensive session spanning 11 distinct parts. Let's begin with Part A, Statutory Anatomy. We start by addressing one central commercial problem. How do we pass on credit for common input services procured at a central location? Under the CGST Act, a taxpayer holding multiple GSTINs under one PAN is treated as a set of distinct persons. This is the legal foundation for both ISD and cross-charge. Common input services are typically procured centrally at a head office but consumed by various branch offices. GST law recognizes two legal routes to pass on the associated credit. The first route is the ISD. It is a pure ITC distribution mechanism under Section 20. Importantly, no element of supply is involved here. It merely reallocates credit already belonging to the entity. The second route is cross-charge. This is a deemed supply between distinct persons under Section 7. It requires valuation under Rule 28 and the issuance of a formal tax invoice under Section 31. This distinction is critical. ISD reallocates credit, while cross-charge creates an independent output tax liability, which is usually offset by an equal input credit in the recipient's hands. Let's look at the statutory anchors. Section 261, which defines ISD, was substituted by the Finance Act 2024 to expressly cover RCM invoices received for or on behalf of distinct persons. Section 24 makes ISD registration compulsory regardless of turnover, while the substituted Section 20 makes the distribution of credit mandatory, not merely an enabling facility, from April 2025. Rule 39 governs the distribution procedure, which was substantially rewritten in 2024. Rule 54 provides the invoicing requirements for both ISD and the new HO to ISD RCM transfer documents. Section 21 deals with the recovery of credit distributed in contravention of the law. For cross-charge, Rule 28 is the key, particularly the second proviso, which allows nil valuation for full ITC recipients. In Part B, we trace the evolution timeline. We move from the original facility regime to the current mandate regime. This context is vital for understanding past and pending litigation. From July 2017, ISD was available as an optional mechanism. Industry practice varied significantly, and there was persistent ambiguity on whether it was mandatory and how to treat employee costs. A major milestone was the 2018 Columbia Asia ruling. It held that internally generated HO services to branches are taxable, and importantly, that HO employee costs must be included in the valuation. The controversy intensified in 2021 with the Cummins India ruling. It held that the HO cannot avail credit on services procured for branches. It must obtain ISD registration and distribute them. In July 2023, the GST Council recommended clarifying that ISD was not mandatory at the time. Circular 199 followed, confirming this optionality and providing relief for internally generated services. The Finance Act 2024 finally amended the law to make ISD mandatory. Notification 16 of 2024 then notified April 1st, 2025 as the effective date for this mandatory regime. As of April 2025, third-party common services can no longer be passed by cross-charge. However, cross-charge remains the route for internally generated services like HR, admin, and treasury support. Our vantage point today is July 2026. We are well past the mandate date, and our discussion proceeds on the basis that ISD is now compulsory law, not just a proposal. Part C offers a comparative reading of 3 reference articles. Together, they trace the full arc from facility to mandate. It is dangerous to read any one in isolation. Reference Article 1 is the best foundational primer for mechanics, such as the distribution formula and tax head mapping. However, its advice to raise invoices directly is now tenable only for non-common services. Reference Article 2 focuses on the Circular 199 era. It flags critical issues like ineligible credit transfer and cross-border services, but its statement that ISD is optional is now historically superseded. Reference Article 3 is the most operationally useful today. It anticipated the mandatory regime and provided the first walkthrough of RCM to ISD invoicing and turnover ratio mechanics for new GSTINs. In Part D, we dive deep into the ISD mechanism itself, focusing on the conditions under Rule 39 and the invoicing requirements of Rule 54. Rule 39, 1, sets strict conditions. Credit must be distributed in the same month it is available via GSTR6, and the amount distributed cannot exceed what is actually available. Attribution is key. Credit for one recipient goes only to them. If it's for some or all recipients, it is distributed pro rata based on their turnover in the relevant period. Crucially, eligible and ineligible credits under Section 17(5) must be identified and distributed separately. The recipient then avails and simultaneously reverses the ineligible portion. Tax head mapping is precise. IGST is always distributed as IGST. However, CGST and SGST transform into IGST when distributed to a recipient in a different state. Finally, every distribution must be evidenced by an ISD invoice or credit note. Debit notes from suppliers follow the same conditions and are distributed in the month they reflect in GSTR6. The distribution formula is C1 equals T1 divided by T multiplied by C. This ensures that the credit is shared fairly based on the recipient's turnover relative to the group. The relevant period for turnover data is typically the preceding financial year. If that's not available for all recipients, use the last quarter where data is available. Turnover is always computed net of GST. Let's look at the mapping table again. CGST becomes CGST locally, but IGST across states. The same applies to SGST. IGST is the only tax head with a uniform rule. It is always IGST. The compliance timeline is tight. Vendors file GSTR1 by the 11th, and the ISD must file GSTR6 by the 13th. This narrow reconciliation window is a major practical bottleneck. In Part E, we walk through a numerical illustration using ABC Professional Services LLP. This case study clarifies how Rule 39 applies in a multi-state environment. Facts: the HO receives a common statutory audit invoice for 10 lakh rupees plus 18% IGST. The total IGST credit available for distribution, denoted as C, is 1,80,000 rupees. The turnover breakdown for the relevant period shows the HO at 40 crore, Delhi at 25, Karnataka at 20, and West Bengal at 15, totaling 100 crore rupees. Using our formula, the HO receives 40%, which is 72,000 rupees. The Delhi branch receives its 25% share, amounting to 45,000 rupees of IGST credit. Similarly, the Karnataka branch is allocated 36,000 rupees, and West Bengal receives 27,000. This accounts for the entire 1,80,000 rupee pool. Note that the HO receives its share as IGST, even though it is in the same state as the ISD. This is because Rule 39(1)(I) mandates that IGST is always distributed as IGST. If the audit fee had been billed by a local Maharashtra vendor, the HO would receive its 40% share as CGST and SGST, while the other branches would still receive IGST. What if 20,000 rupees was blocked? It must still be distributed in the same 40 to 25 to 20 to 15 ratio. Each recipient avails it and then simultaneously reverses it in their own GSTR 3B. In Part F, we shift to cross-charge. We examine its legal basis, the scope of what is cross-charge today, and the critical valuation rules under Rule 28. Cross-charge rests on Section 7. A supply of services between distinct persons in the course of business is treated as a supply even without consideration, triggering GST. Post-2025, third-party common services must go through ISD. Cross-charge is now reserved for internally generated services such as HR, admin, and treasury support rendered by HO personnel. Valuation follows Rule 28. You can use open market value, the value of similar services, or a cost plus 10% method. The second proviso to Rule 28(c) is the most critical tool here. This proviso states that if the recipient is entitled to full ITC, the invoice value is deemed to be the open market value. This allows for defensible nil or nominal valuation for internally generated services. Circular 199 provided vital relief. It confirmed the nil valuation position and clarified that even for partial ITC recipients, HO employee costs need not be loaded into the cost plus valuation base. This evolution shows how Circular 199 administratively diluted the earlier harsh positions of the Columbia Asia and Cummins India rulings regarding employee costs, providing a practical shield for taxpayers. However, be cautious. The JSW Steel ruling warns that mechanical book entries without a genuine underlying service are open to challenge. The Tupperware ruling reinforces that services cannot simply be absorbed at the HO. Part G addresses the complex RCM interface. Since an ISD is not a supplier and cannot discharge RCM itself, a specific credit transfer process was introduced in 2024. The process has 4 steps. First, the vendor invoices the regular HOGSTIN. Second, the HO discharges the RCM liability in cash through its regular GSTR3B and avails the corresponding credit. Third, the HO issues a document under Rule 54(1)(a) to transfer that credit to the ISD GSTIN. Finally, the ISD includes this document in its GSTR6 and distributes the credit onward to the branches. The Rule 54(1)(a) document is specific. It must contain the original supplier's details, the ISD's name and GSTIN, and the exact value and amount of credit being transferred. Practical friction points remain. These include whether the Rule 54(1)(a) document needs disclosure in GSTR1, the applicability of e-invoicing, and the evolving portal-level sequencing for tax head routing. In Part H, we summarize 4 rulings you should know cold. These cases have defined the landscape of ISD and cross-charge over the last decade. The 2018 Columbia Asia ruling was foundational. It held that HO services are taxable supplies and that salary costs must be loaded into the valuation, rejecting the employer-employee exclusion at the branch level. Cummins India in 2021 went further, holding that the HO cannot avail ITC on third-party services procured for branches. It also intensified the salary cost inclusion requirement under Rule 28(c). Tupperware reinforced that HO services cannot be absorbed without cross-charge. JSW Steel, however, provides a defense stating that cross-charge invoices raised as a routine book entry without genuine service can be challenged. In Part 1, we address 6 issues that are still settling post-2025. These emerging interpretive positions require careful evaluation by tax practitioners. First, what does distribution in a month mean? Does it refer to the calendar month of receipt or the month of actual entitlement? Second, the avail then reverse mechanics for ineligible credit still face implementation friction in GSTR 6. Third, the applicability of e-invoicing to ISD and RCM transfer documents remains unconfirmed by CBIC. Fourth, cross-border services between distinct persons raise complex questions about export of service conditions. Fifth, it is unclear if Circular 199's nil valuation relief extends to related persons beyond distinct persons. Finally, practitioners are exploring credit note corrections for historical overcharging of cross-charge. Part J provides the practical compliance checklist for your practice. We've divided this into registration, recurring compliance, and legacy positions. To get ready, map all GSTINs and apply for ISD registration. Importantly, notify all common service vendors to reissue invoices to the new ISD GSTIN and build a robust expense classification matrix. Monthly compliance is a race. Reconcile GSTR6A and file GSTR6 by the 13th. For RCM, ensure the regular HOGSTIN discharges the liability in cash and transfers the credit to the ISD in the same month. For cross-charge, identify genuine services to avoid ERISA High Court risks. For full ITC recipients, a nil invoice is defensible, but for partial ITC units, apply a cost plus 10% valuation while excluding employee costs. Finally, evaluate your legacy positions. If there was past under-compliance, consider voluntary discharge. For pending litigation involving employee costs, Circular 199 should be used as a primary mitigating factor in your defense. This concludes our comparative study on ISD and cross-charge. Mastering these mechanics is essential for ensuring robust compliance and optimizing credit flow in your organization. Thank you for participating. If you found this session valuable, please like and subscribe for more in-depth tax insights.